Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research. I'm going to be talking today about developments in, intellectual developments, if you like, and developments in thinking about money in Britain, America and elsewhere. It's May 2024. The Institute of International Monetary Research has been around now for about 10 years. And we've been emphasizing in our work the relationship between the growth of the quantity of money and the growth of nominal GDP, and then going on from money to inflation. Now, in the early 2020s, we've had an enormous success because we, particularly me, I suppose, forecast in spring of 2020 that there was going to be a flare-up in inflation in the main economies, which happened when most members of the economics profession were expecting years of disinflation or even deflation. That, of course, was reflecting the success of the underlying theory, the quantity theory of money. What I want to emphasize today is that we've got a couple of interesting developments on this front. First of all, I'm about to publish a short book called The Quantity Theory of Money, a New Restatement. It's coming out from the London-based think tank, the Institute of Economic Affairs, and we'll tell you more about that as we know about the publication date and so on. And then there's been something of a change in the Bank of England's monetary policy report. The latest report contains several pages about the quantity of money and the relevance of that to inflation prospects. So I'm going to try and link up these two developments in the current video. In the book, The Quantity Theory of Money, a New Restatement, I noticed that there are monetary and non-monetary approaches to inflation. Obviously, I deplore the non-monetary approaches, but and they are mentioned some length in the book, particularly the what I regard as the curse of interest rate-only macroeconomics. But there's also a lot about different approaches to inflation from a monetary perspective. And one of the things I do, which may come as a surprise to people, is that I emphasize that my views on money are different from other monetarists. Now, there are, and in effect, there's a kind of intellectual duel that's been going on. It's been going on in the way for all my career, but I want to highlight what's recent developments in that debate. There are different measures of money. There's the monetary base, there's narrow money, and then there's broad money. Now, I will in the next few minutes just define those. It's fair to say that the dominant tradition in monetary economics in the late 20th century came from the Chicago School, the University of Chicago in the USA, led by Milton Friedman. I had some differences of view with Friedman, and those differences are, in my view, of some importance to understanding what's happened in the early 2020s. I'm very much a supporter of broad money monetarism, and the new book I've got coming out could be viewed as a manifesto for broad money monetarism. The Chicago School saw room for the monetary base and narrow money in this subject in a way which I rather disagree with. And that is really going to be what I talk about today. In my view, the Chicago School of Monetarism has failed, and it is in effect more or less dead. I mean, I could discuss whether it's dying or it's dead, but whereas my kind of monetarism, broad money monetarism, is alive and well. That's what I'll be saying in this video. Now, to understand my analysis, you do need to appreciate the differences between these money measures. In a modern economy, we don't use gold or silver. There's no precious metal or commodity used at all. Instead, we use the liabilities of the banking system, bank deposits, to make payments, and we also use, to some extent, the liabilities of the central bank itself. There are four kinds of monetary asset. There are obviously notes issued by the central bank, the legal tender, and we use those to make payments. We deposit those notes at the banks. We then give instructions to the banks to make payments on our behalf. Strictly, these instructions are instructions to make payments in legal tender. The banks therefore need to hold some cash reserves in order to carry out these instructions for us for their own settlement between themselves. So you've got these four kinds of money. You've got the notes, you've got the two types of deposit. You've got the deposits that can be used straight away at your bank. You write a check or give a payment instruction against them, they're immediately exercised. And then the banks, also banks and building societies, whatever they're different institutions, different countries, but there are savings deposits, deposit accounts, time deposits, whatever you want to call them, where some notice period has to be given before the money can be spent. So notes, sight deposits, current accounts, then another kind of deposit, which is deposit accounts or time deposits. It's the third kind. And then the fourth kind is banks' own cash reserves. Okay, those are the four. Now, the first kind of money, first measure of money, if you like, is the so-called monetary base. This consists of the liabilities of the central bank. Obviously, the Bank of England issued these banknotes, so they're the liability of the central bank. The banks must hold some cash reserves to carry out those payment instructions from us. They're also a liability of the central bank. The other then deposits are liabilities of the commercial banks. The second kind of money is called narrow money, and this consists of not all of the monetary base, only the notes, and then the sight deposits, the current accounts at the commercial banks. This is money that can be used straight away. And then the final kind of money, the broad money, consists of the notes, plus the sight deposits, current accounts, plus also the time deposits, the deposit accounts. And broad money, I'm simplifying a bit, but broad money is all the deposit liabilities of the banking system. Now, I know banks can issue bonds, they've obviously got equity capital, okay, I know that, but more or less we can regard broad money as representing all of the deposit liabilities of the banking system. Now, this is very, very important. What that means is that if you've got some money in the bank, you've got a deposit account, you've got a current account, and you can't change that quantity in total except by changing your spending relative to your income, spending above income or spending beneath income, which then goes into your bank account. So the broad money is the crucial measure of money in understanding the relationship between our money holdings and our expenditure and our portfolios. It's my view. I very much emphasized it in my career. I've been pretty successful with that approach to the subject. The problem with narrow money is that I can change it by switching between the different kinds of accounts. If, for example, the rate of interest on my deposit account goes down, I hold less of it and put more into my current account. It's more convenient. But that doesn't change anything in the economy. It doesn't affect my spending. It's just a transfer inside the broad money total. And narrow money therefore affects the economy's behaviour and the relative attractiveness of different kinds of money. I don't look at the monetary base almost at all in my economics. I don't believe that the quantity of the monetary base determines how much the banks have in terms of their deposit liabilities, a really crucial number. And I don't think that the monetary base has much effect on total spending. Spending with notes is a tiny fraction of total spending, and banks' own spending of their cash reserves, again, is a tiny fraction of total spending. In any case, what banks do doesn't depend upon their cash reserves. Now, before I come on to the debate between the Chicago School approach and the broad money approach, I should just emphasize that there are many other schools of thought, all sorts of different countries. I'm not saying these are the only two schools of thought in monetary economics, but I need to press on and proceed with the argument so that I get my main points home. So here we have these two schools of monetarist thought. According to the Chicago School, the main proposition is the famous equation of exchange, MV equals PT. Friedman and others used to emphasize the stability of velocity of money and then of the so-called demand for money function. And they believed that all money aggregates were relevant to the analysis of the economy, and that whether it was narrow money or broad money, they could be viewed as determined as a multiple of the monetary base. Now, broad money monetarism is different from this. It's got many other influences on it. Certainly Keynes is part of in my view, as I explain in the short book I'm bringing out. There's also a chap called Sir John Hicks, whom I knew slightly, who also was important to it. Many other people. I'm not sure that Hicks would like to be known in this company, but his thinking was important to it in my view. The crucial idea is that what we spend, what we receive in incomes, the value of our wealth, are only at the equilibrium values if the amount of money we hold is actually what we really want to hold. You know, suppose that everybody wants to they've got their money balances, you add it all up, and it's less than people really need to carry out their transactions. It's too small relative to the value of all of the assets in the economy. Then behavior changes. There's change in spending levels, they spend less, they sell some assets, so that the value of spending, the value of national income, the value of wealth, they all change because of the lack of a balance between the demand to hold money and the quantity of money in being. And in the analyses I do, it's only broad money that has a causal role in the economy. That goes back to what I've just been talking about. Narrow money can be changed by money transfers between different kinds of account. Logically, that is impossible for an all-inclusive measure of money. And I don't regard the quantity of money as being determined as a multiple of the base. Instead, the banks have have to think about many things when they decide the size of their balance sheets, and their capital position is very important relative to the risks they take. Also important, by the way, whether customers want to borrow from banks, because when they borrow from banks, the banks expand their assets by making a new loan. That adds a new deposit on the other side of the balance sheet. It's very important, in my view, to respect the fact that agents are trying to maximize utility, in the case of individuals, and profits in the case of both companies and banks. Now, we had a big debate in Britain in the early 1980s about whether the quantity of money was a multiple of the base, whether the Bank of England should adjust the monetary base to control the quantity of money, monetary base control. There was a huge experiment in the USA under the chairmanship of Paul Volcker in so-called reserve targeting, which is kind of monetary base control. I just summarize those debates and discussions and experiment by saying that generally monetarism in that sense failed. Monetary-based control was not adopted in the UK, and in the United States, Volcker abandoned reserve targeting in 1982. Now, I think it's fair to say, and I'm generalizing a bit here, that broad money monetarism has been most prominent in the UK. That partly reflects my influence, but it's more general, because back in the late 70s and early 80s, when British policy was monetarist in this sense, it was broad money monetarism. The Chicago School, by contrast, is rather American. There are different philosophies of central banking, by the way. This is, again, a huge subject, but some people think that the central bank shouldn't be a bank, shouldn't lend to banks when they have cash problems. This is a tradition that goes back to David Ricardo in England in the early 19th century. Then there's the opposite tradition associated with Walter Bagehot, a book called Lombard Street, which is after the 1866 crisis in England. The Chicago School has advocated 100% cash reserve banking to make banks very safe, and so that no money can be created by the extension of bank credit to the private sector, whereas none of this kind of stuff is found in broad money monetarism of the kind I believe in. We tend to emphasize, as I've been saying, banks' capital as the crucial thing in how bank managements think about their balance sheet. The Chicago School tends to emphasize the monetary base, banks' cash. In the more extreme versions of the Chicago School, the monetary base either by itself determines national income, which I find fantastic, or the monetary base determines the quantity of money dominated by deposits, and then money determines nominal GDP. In broad money monetarism, one hardly mentions the monetary base. The monetary base simply adjusts to what the banks want. Okay, that's all by way of introduction. I'm sorry it's very difficult and analytical. This is very important understanding this subject. It's very important understanding, in a sense, what's gone wrong with monetary economics, why this inflation therapy has occurred. Let me come now on to the Bank of England's monetary policy report, the latest issue. It has several pages there which are very much on monetary themes. It is very, very much broad money monetarism. It is not Chicago School monetarism. Let me just illustrate that. All the references to money are to broad money, in fact to a measure of money called M4X, which some economists at the bank have pioneered. There are no references to the monetary base. There's a lot of work on the credit counterparts to money, reflecting the view that the quantity of money is determined by the extension of bank credit. There is nothing at all about the behavior of the monetary base in determining the quantity of money. There's a lot about different sectors' money holdings, about the impact of the different sectors' money holdings on their behavior. So household money is linked to consumption, corporate money linked to investment, money held in the financial sector to the level of the stock market. I think it's a bit schematic, but that's what the Bank of England does. I agree very much with the general trend of this kind of thinking. And so, if I may say so, given the forecasting success that we've had in the early 2020s, and indeed this sign that the Bank of England may be responding to this kind of thing, I would say that broad money monetarism is alive and well, even though it's very much a minority position in macroeconomic thinking and macroeconomic policy making. On the other hand, Chicago School monetarism is dying and perhaps dead. There are no prominent monetary economists at the University of Chicago today. Milton Friedman himself spent most of his time in retirement in California associated with the Hoover Institution. I'm not saying there's plenty of distinguished work coming out of Chicago. There are obviously many economists are involved with the teaching of money and banking and macroeconomics. But there's no figure that really stands out as being in the quantity theory Chicago School tradition. I mentioned a second ago that Friedman spent most of his retirement in California associated with the Hoover Institution. Well, there was a letter written by some economists in 2010, some of them, four of them at the Hoover Institution, where this letter seems to have begun, I don't know, but, this open letter to Ben Bernanke said that given what was then going on to Federal Reserve policy, that inflation was in prospect. Essentially, the asset purchases being carried out by the Federal Reserve were going to lead to excessive monetary growth, and then the result would be, to quote, currency debasement and inflation, and they didn't think, by the way, that this was relevant to the Fed's aim to achieve more employment. So these economists wanted to end these large-scale asset purchases, quantitative easing, and they were worried about rapid inflation. Now, they were completely wrong. The inflation rate in the 5 years from 2010 in the USA and elsewhere was the lowest, certainly since the Second World War, and some of the lowest for such a long period in the 20th century. What have they got wrong? Well, essentially, they were emphasizing the monetary base, which did indeed rise very rapidly. What they didn't notice, very serious mistake, what they didn't notice was that the banks were under pressure to reduce the size of their balance sheets because of the Basel rules that had come in from autumn 2008. The capital requirements of the banks were increased by about 2/3. And that meant that the banks had to shrink their loan portfolios, sell off securities, and as they were doing that, the quantity of money would have fallen without the asset purchases carried out by the Federal Reserve in the US case, by the Bank of England in the UK, and so on. And the net effect was that money growth was very low, and so was inflation. And the signatories of this letter to Ben Bernanke were completely wrong. They were thinking in a Chicago school sense, and they simply got it wrong. I would say that the most prominent broad money monetarist in the USA at the moment is Steve Hanke at Johns Hopkins University, whom I sometimes work with. And he is cited, curiously, in the latest biography of Milton Friedman as an example of quantity theory economics. Fine, but that then fits in with my thesis that broad money monetarism is alive and well, whereas Chicago school monetarism is dead or dying. I know that Hanke believes that it's capital that matters to monetary growth more than the base, because we've written an article about it together. Okay, what all monetary economists agree, of course, is with Milton Friedman's dictum that inflation is always and everywhere a monetary phenomenon, and that certainly unites us. We are, both of these schools of thought, opposed to interest rate only macroeconomics, which excludes money altogether. I'll talk about that next month.